The Most Important Thing by Howard Marks is a seminal book that explores the core principles of investing, offering practical wisdom and insights drawn from the author's decades of experience in the world of finance. Marks, a legendary investor and co-founder of Oaktree Capital Management, emphasizes that successful investing is not about following fads or market trends but about understanding the underlying factors that drive investment decisions. The book provides a thorough guide to thinking about investing in a disciplined, rational way, with a focus on risk, opportunity, and psychological discipline. The central theme of the book is that the most important thing in investing is to control risk. Marks argues that managing risk is far more critical than trying to pick the next big thing or striving for market-beating returns. The book starts with the basic premise that every investment carries risk, and that it is essential for investors to recognize and evaluate the risks they are taking. Instead of trying to predict the future or time the market, Marks suggests that investors should focus on mitigating downside risk while being alert to the possibility of generating attractive returns. One of the key concepts introduced in the book is the importance of second-level thinking. Marks contrasts first-level thinking, which is superficial and simplistic, with second-level thinking, which requires deep analysis, reflection, and understanding. First-level thinking might involve buying a stock simply because it's popular or trending, while second-level thinking involves questioning assumptions, considering various factors, and recognizing when a security is mispriced in the market. Marks believes that second-level thinking is crucial for distinguishing yourself from the majority of investors who often follow herd behavior and act impulsively based on short-term market fluctuations. A major focus of The Most Important Thing is the idea of market cycles. Marks argues that markets operate in cycles, driven by fluctuations in investor sentiment, and these cycles create both risks and opportunities for investors. According to Marks, understanding these cycles is essential to navigating the investment landscape successfully. He explains how periods of optimism and euphoria often lead to overvaluation of assets, while periods of pessimism and fear lead to undervaluation. The key to successful investing, Marks says, is to recognize where we are in the cycle and position oneself accordingly, buying when others are fearful and selling when others are greedy. In addition to market cycles, the book covers the concept of value investing, emphasizing the importance of buying assets when they are priced below their intrinsic value. Marks notes that value investing is not about finding cheap stocks, but rather identifying securities that are undervalued relative to their true worth based on fundamentals. The intrinsic value of an asset is determined by its potential to generate future cash flows, and value investors seek to buy securities at a discount to this value, creating a margin of safety. This margin of safety helps protect against the risk of permanent capital loss and ensures that investors are compensated for the risks they take. Another critical concept introduced in the book is the relationship between risk and return. Marks argues that in the world of investing, higher returns are typically associated with higher risk. However, not all risks are equal, and some risks can be mitigated or avoided. Investors must evaluate the trade-off between risk and return and understand that seeking higher returns without acknowledging the risks involved can lead to significant losses. Marks stresses the importance of risk management, advocating for a balanced approach that minimizes the chance of losing money while maximizing the potential for returns. The book also addresses the psychological aspects of investing, emphasizing the role of investor behavior in shaping outcomes. Marks points out that investors are often influenced by emotions like fear and greed, which can lead to poor decision-making. These emotions drive investors to chase after trends, ignore risks, and make irrational decisions based on market noise. Marks argues that the ability to control emotions and remain disciplined is one of the key traits of successful investors. In particular, he stresses the importance of contrarian thinking, going against the crowd when necessary and maintaining a long-term perspective, even when short-term market movements are unsettling. A major lesson from the book is the importance of patience and discipline in investing. Marks emphasizes that successful investing is not about making quick profits or acting impulsively, but about staying the course, sticking to your investment philosophy, and being willing to endure short-term volatility in pursuit of long-term gains. He advocates for a value-oriented approach that involves careful analysis, a deep understanding of risk, and the willingness to buy undervalued assets while being cautious of overhyped, overpriced securities. Marx also explores the concept of asymmetry in investing, which refers to the idea that the potential for reward and the potential for loss are not always equally balanced. In some investments, the downside risk is far greater than the potential upside, and these situations should be avoided. By focusing on investments with favorable risk-reward ratios, investors can improve their chances of success. Marx believes that an investor's focus should be on the preservation of capital, seeking opportunities where the potential for loss is limited and the potential for gain is substantial. Throughout the book, Marx emphasizes the importance of learning from experience and other investors. He believes that while theory and models can help guide decision-making, real-world experience is the best teacher. Marx shares numerous anecdotes and insights from his own career, offering readers a valuable perspective on how to approach the complexities of investing. He also stresses that successful investors should continually learn, adapt, and refine their strategies based on new information and changing market conditions. The book concludes with a discussion of the importance of humility and acknowledging the limits of one's knowledge. Marx argues that no investor can predict the future with certainty, and that the key to long-term success is to recognize that uncertainty is an inherent part of the investing process. The most successful investors, according to Marx, are those who can accept uncertainty, manage risk effectively, and maintain a rational, patient approach in the face of market fluctuations. In conclusion, the most important thing is an insightful, thought-provoking book that offers practical advice for investors looking to navigate the complexities of the financial markets. Howard Marks provides a roadmap for understanding the crucial elements of successful investing, managing risk, recognizing market cycles, practicing value investing, controlling emotions, and maintaining discipline. The book's core message is that while the pursuit of high returns is important, managing risk and understanding the psychology of investing are far more critical to long-term success. For investors who want to build a solid foundation of knowledge and make better investment decisions, the most important thing is an essential read.